Over the past decade, the financial reporting landscape has seen significant change. Finance executives face mounting pressure to increase the accuracy of financial reporting while decreasing turnaround time. Costs continue to be highly scrutinized. Meanwhile, regulatory agencies have introduced a host of new standards and accounting rules, changing materiality thresholds and requiring detailed schedules. And to complicate matters, many finance organizations are being asked to do more with less. As a result, today's finance organizations face multiple priorities that include the oversight of financial transactions, the management of enterprise performance, attestation of financial reporting, and timely close and consolidation of financial data. On one hand, finance departments are always seeking ways to increase the efficiency and timeliness of their financial close and compliance processes. On the other hand, not only must information be communicated at a higher speed, but it must also increasingly support the business needs of and the decisions made by management.
Joining us is Lawrence Maisel, president of the Decision View Group. It's great to see you again, Larry.
My pleasure, Mike.
Well, we all know that the business world is changing and that the pace of change is increasing. Now, I'm curious, what does this mean for management reporting?
Well, Mike, it's very important that companies understand those essentials, including speed, agility, and data, as well as management reporting, which leads to good decision-making. The reason why I think those are essential is speed is it allows an organization to know what to do with the information once they have it. Agility is the ability to respond quickly in the market. And data is what gives them the insight to understand how best to respond. And usually the vehicle for sharing that information is the management information and accessibility to that information, which leads to smart decision-making.
Over the years, I've heard organizations say that they seem to be drowning in data, but still starved for information. From your perspective, Larry, are we ever likely to bridge the gap between the incredible amounts of data that we have access to and the optimal use of that data to increase business performance?
Well, I think the answer is a resounding yes. And the reason why I feel that way, it reminds me of a cartoon that I sometimes share with my clients. And in that cartoon, there's the financial professional sitting in an office, totally overwhelmed with reports, wall charts, and other data information. But the one thing that's important is that without interpretation, data is just numbers. The key is that people are the ones that are really going to be the group that interprets this information and uses it to make smarter, faster, better decisions. So what is happening, Mike, is that many organizations are adopting better tools, better processes in order to achieve the use of this information effectively. One of the things that I suggest to my clients that I think is an effective way to deal with this is to adopt a KPI or Key Performance Indicator management reporting process. A recent study showed that an organization that adopts KPIs, Key Performance Indicators, could have as much as a 20% increase in profitability by the year 2017. Well, the key here is not whether it's the absolute number. It's directional. Many other studies continue to support the fact that key performance indicator reporting leads to better performance. There are other aspects of that study, including the use of both lead and lag measures, meaning those that reflect past results. Leading indicators are those that will give you an insight into what might be forthcoming so that you can react appropriately. So, Mike, one of the things that becomes important to the financial professional is not only to be able to measure the numbers with integrity, but to really look at what those numbers are telling us. It's the interpretation, the narrative, that enables the financial professional to not only be good controllers, but also to be effective business partners with their colleagues in the organization.
You know our audience, Larry, since they're your clients, corporate financial executives. As accountants, many of them are accustomed to looking at the rearview mirror. How do you get them to become more forward-thinking?
One of the other things that I've also noticed in my years of experience in working with finance professionals is they're very comfortable working with the numbers and with results, being able to report what is recorded into their accounting and finance systems. But we need to be adapting as financial professionals. And the key adaptation is to begin to look forward, to be able to anticipate in terms of our analytics what might be coming over the next several months or quarters. And again, forecasting is a fundamentally important tool to enable that process.
Speaking of measuring business performance, Larry, a recent survey said that was the most important challenge facing financial executives. Well, if that was the good news from the survey, I suppose you'd better tell me the bad news too.
Well, Mike, I don't usually like to deliver bad news. I usually like to deliver solutions. However, the bad news here is the 80% is the importance of measuring business performance. The bad news is only 56% of the respondents felt that it was being effectively performed. Well, considering that it's a 24% gap between importance and being effectively performed, the real takeaway here is that there is such a gap. There is such a demand to improve the effectiveness of performance reporting by organizations.
Let me ask you specifically about the closing process, Larry. I suppose in a way the accounting close is like the supply chain for financial reporting, isn't it?
Well, it is in many ways. There are many similarities. It reminds me of an image of an iceberg, where on the surface you see some of the aspects of the close, but beneath the surface, as in an iceberg, there's many other important aspects. The below the surface aspects really have to do more with accounting transaction systems and operating systems. Let me give you for instance. When you have an order processing system, that system provides information about product revenue, channel distribution, other important aspects of the information. But if it doesn't close on time, it delays the closing itself. Or, worst case, if it has poor information that has errors within it, it can lead to misinformation in the management reporting. Well, one of the examples, Mike, is the order processing system, which provides to the organization the revenue information for that period close. And given some of the recent FASBs on revenue recognition, the finance function really has an important responsibility for compliance and adherence as it relates to the closing process. But it's not only limited to those operational systems. Again, the human resource, the HR systems, not only provide important information about expenses and other operational data such as headcount, but with the Affordable Care Act, it has created an additional set of regulatory reporting that the organizations need to have on a timely basis in order to be compliant with the federal regulations and state regulations. So, Mike, the implication now is with all the additional reporting requirements and technical requirements, any delays in this information flowing into the financial closing systems really provide an opportunity to delay the issuance of the reports and also might lead to errors in the information, which, if not caught early enough in the closing process, will lead to misinformation being reported externally, internally to management, and now to regulators and other stakeholders in financial information.
Well, that makes sense, Larry. So tell me, what are the benefits from improving the closing process?
Mike, several of the benefits that I have seen from my experience in working with clients in this particular area of closing on an accelerated basis. The three benefits are, first, the timely distribution of information to stakeholders. Not only does management get the information and able to interpret it and make decisions, but also there's a study, Measures That Matter, that indicated that those companies that can provide external reporting to stakeholders have an 11.2% premium in their share price. So I think that there's a real benefit both to the internal organization and to your shareholders That's the second benefit is the allocation of resources. The accounting team and the financial professionals want to use their time to do analysis and planning and forecasting, getting away from the rudiments of the closing process. Actually, it also is a wonderful way to reduce turnover, which comes about very often because the closing process is such a repetitive process that doesn't really take advantage of the skills and competencies of your team. And the third benefit is a reduction in cost, not only to the internal resources used to close the books, but might have a very beneficial effect on the external auditor fees. And as an ex-CPA with KPMG, I certainly understand the responsibilities of external auditing.
Thanks, Larry. We'll return to your commentary in a minute.
As Larry Maisel indicated, those finance organizations that commit to continuous improvement of the closing process often find themselves pursuing milestones that promise benefits for business decision makers as well as for financial executives, auditors, and capital providers. Of course, in improving the closing process, it's vital that organizations define an optimized close and understand how better to align processes and technology for the organization's financial close and its reporting environment.
Tell me, Larry, what do you take away from the benchmarking data about cycle time for financial executives?
Well, Mike, one of the things that executives benefit from by having access to the information sooner in the closing study and the issuance of the management reporting, they can make more informed decisions and certainly at a faster pace. Let me give you an example. There are two companies. One company closes its books in eight days, which is supported by benchmarking studies by other reputable organizations. Another company, Company B, closes their books in 22 days. Well, the difference is not just the number of days in the closing process. The difference is if Company A sees that there's a downturn in demand for its products, and as a result adjusts its production and inventory levels, it could lead to increased profitability. Whereas Company B, that closes its books at more than 14 days later, might not adjust its production schedules, will build inventory, potentially have write-downs, and certainly will affect its operating profit. So there's a real monetary benefit to accelerating the close, in addition to the benefits that we described in terms of stakeholders with the premium that is given to the price-earnings ratio of those companies that close quicker versus those that are slower in this closing process. One of the ways to understand how you monetize is I looked again at this benchmark data, and the difference between the top performer and the bottom performer, which is a significant spread. If you use a company that has $500 million in revenue, the top performer will have a savings of at least $2.5 million, according to the benchmark savings. One of the things I ask my clients when I go over this data with them is, how are you going to spend the savings? How are you going to deploy it? You're going to have an excellent opportunity to use an additional $2.5 million. Some of it could be saved, and some of it can be invested in other things that you need to run the organization more effectively.
As financial executives, our viewers certainly understand the financial reporting process. But explain to me, how does improving the close eliminate inefficiencies in the downstream processes?
That's a good question, Mike. And again, we refer back to the iceberg image. The way it is that the downstream systems often might have to be improved in terms of its processing efficiency. Companies that begin to look at their downstream systems understand and identify what opportunities to improve the quality of the data coming out of those systems as well as the efficiency. What I like to do, Mike, with my clients is to take a page out of the Six Sigma playbook, where you go into the downstream systems, you develop both a current and future state target, You understand what are the key bottlenecks, what are the key contributors to an efficient flow, working with the functional team, having the insight now, using good process flow techniques. Again, using the Six Sigma understanding, you can identify root causes and other areas that are causing delays or errors. Once you understand the current state, it is a straightforward process to improve it over time. Quick wins, manageable improvements. It's a little bit like, how does the old adage is, how do you eat an elephant? And the answer is one bite at a time. So it's important that you don't overpromise and underdeliver, but rather understanding the expectations to be set, and then to deliver quick wins to your organization, which will be sustaining to get other improvements done.
I'm curious, what signals or warning signs are our viewers likely to see?
Well, Mike, some of the warning signals that we often find when we work with our clients is certainly the delay in the closing, and we can usually understand this when we can see a HESS Syndrome. You ask, what is HESS? HESS. Well, I tell my clients it stands for holidays, evenings, Saturdays, and Sundays, because the workload, it requires that type of commitment. Another is the lack of adherence to a documented closing schedule. Very important that organizations develop a closing schedule so that they can manage and monitor the timely submission and preparation of the information that will lead to consolidation, reporting, and analysis. A couple of other symptoms that we find is the use of many manual adjusting entries at the end of accounting period. Certainly, the feeder systems have complicated or no automated interfaces with the general ledger system. Certainly, accounting has built complicated workarounds, spreadsheets, and manual reports. What I mentioned earlier, significant employee turnover in accounting and reporting. Too many surprises at the end of the month, being reactive versus proactive. And certainly a high number of kicked-out error transactions that cause the organization to have to do error correction. These are just some of the more frequent indicators of a closing system that can really be improved and therefore achieve those benefits we described earlier. Mike, it reminds me of the tax professional who in many ways may dread April 15th or March 15th because you have your tax closing, and many of them say, don't talk to me until after the 15th of April. Well, they go through this generally once a year. Can you imagine the financial professional having to do this 12 times a year, having that same deadline to be met, and all the required paperwork and reporting burdens that are attendant to that process? So the more efficient and effective you can make that process, the more the accounting professional, the financial professional, really can use their time and devote their time to those areas that really leverage their skills and competencies.
You've analyzed the closing process in organizations of various sizes. So tell me, where do the typical bottlenecks come from?
In terms of bottlenecks in the closing process, it's been studied that 24% of the bottleneck relates to the fact that there are manual processes, manual entries, some of which don't need to happen. They can be automated as automatic readjusting entries. Another has been 24% relates to non-integrated systems. Certainly having to close several different systems, often with the similar charts of account, creates delay and also creates the opportunity to have errors introduced into the data quality. And 12% of the bottleneck is related to staff shortages.
Okay, so we've got challenges and issues. What should finance be doing?
Let me offer a 5-step suggested approach that we found to work effectively with our clients. Well, step one is to develop a charter and achievable objectives. What are you trying to gain out of this process? And where is your charter? Where is your ground rules to allow you to go and look at operating systems and areas outside of finance, remembering that iceberg image that we talked about? Well, the charter gives you that authority, gives you that legitimacy. The second step is to organize a project team that includes the affected functions and complementary skills. It's very important that you include those individual or team members who are in the functional area, not only for their knowledge, but as importantly, to get them to be part of the solution and to be advocates within their own functional group. Very often, if it's someone out of that function, for example, order processing, as we mentioned earlier, they will be more credible with their colleagues within the function than having someone from a finance and accounting come in and tell them what to do. So we find that to be a very effective change management approach. The third step is to define the current state and target state we talked about earlier, which is a step out of the Six Sigma playbook. Fourth step is to determine how to improve. Very often, it could be a change in policy. It could be eliminating steps that are wasteful, or you can streamline a process. Example of a streamlined process might be on the month-end close, we use the summary accounts and not all the detailed accounts that have to be reconciled unless there's a particularly obvious error. So streamlining might be how you approach it rather than doing the same thing each month. Certainly on the quarter end where there is SEC and other regulatory reporting, then you may want to review the detailed accounts. And then the fourth area, first being policy, second being eliminate wasteful steps, third being streamline the process. The fourth might be to adopt better automated tools to facilitate the closing process. And the fifth step is to understand and develop for these improvements what are the right implementation plans, and certainly to use good best practices of change management.
You've been through it with lots of organizations, Larry. So tell me, are there typical questions a company needs to ask in order to know how to improve the close process?
Well, thanks, Mike. Some of the questions that are included in the questionnaire are, for example, does your activity, the closing activity, begin on the last day of the month? Very often you can begin that process earlier so that you will shorten the time period for actual reporting and the benefit that we mentioned earlier. Another is there time for analysis and critical thinking? Again, if you're rushing to close the books, you're spending too much time on validation and not an appropriate portion of time on analysis and reporting. Certainly, what we talked about earlier, is there good adherence to your closing calendar in terms of the number of work days, and who is responsible for providing that? Again, what we talked about earlier in some of the symptoms, the questionnaire asks, are there many manual journal entries that are being posted at month end? Again, Mike, I can go through each of those questions, but as you said, we will be happy to share that with your audience.
And presumably there are some techniques that you consider best practices.
Well, Mike, several of the best practices that we have found, one would be having integrated systems or a single instance of the system which allows you to combine data, which will contribute to data quality and certainly to quicker closings. Another best practice is the adherence to deadlines and cutoff schedules. Another that we found has been online access to banks, vendors, and other outside service providers. Understanding by having online access, it's not only the speed that this allows, but it really improves the data quality because the outside service providers are presumably running quality systems, which you might be checking through your supply group, but assuming that they do have data quality systems, then you're getting it and you don't have to retouch the data. It's a one and done approach to closing. The electronic submission and interfaces with allows you to use a two-step validation process. Let me describe the 2 steps, and we found this to be very, very critical. Step 1 is you look at the validity of an account number or the validity of the number of digits. The number of digits could be, if it comes in, we're expecting $10,000 in value, and it reports as $10 million in value, well, that's an obvious error, and it should be kicked out and reviewed. So that's step 1, where you're looking at one by one the validity of information as it comes through. The second step, and many companies don't do this, but this is one that we found to be very effective with our clients, is what we call the combination edit. Where does that account fit with that department number and the values? And so the combination edit is not only is the individual piece of data valid, but is it valid in combination? And that becomes a very important way to reduce errors in the closing process. 2 more of the best practices that we found is certainly to begin the closing schedule before the period end. Oftentimes we call that a soft close versus a hard close. The soft close could be something we do on the month, where we take major accounts. A hard close is where we do deeper analysis, more reconciliation, certainly because the risk management of reporting to regulators and shareholders become very important, where you don't want to recall any information or find that it has misinformation. And the last step certainly is to eliminate non-value-added processes.
I seem to recall from my one college course that included analytics that we studied Gantt charts. To what extent would those be helpful improvement tools in accelerating the closing process?
Mike, and I see that you might be close to my age, but certainly not my age, and it is really delightful that you can remember your courses in college. I'm having trouble remembering what college I went to sometimes. Anyhow, the improvement tools, such as a Gantt chart, can help the team identify and visualize dependencies and therefore potential bottlenecks. There are other known areas that can also be beneficial. First, the team can redesign the sub-processes to gain more efficiency and accuracy. Second, the team can assign accountabilities for meeting agreed schedules and deadlines. Third, the team can foster a continuous improvement culture. And fourth, and finally, the team can manage the change process by enabling training, education, and other communications.
You mentioned doing more with less, Larry. In this time of resource constraint, how can you make a case for allocating additional resources for these changes?
Well, when I sit down with my clients, Mike, and they certainly come back to me and say, well, we already have full days and many times full evenings. So the question is, how do you do more with less? And I say to them, Mike, if you eliminate and streamline the processes that you don't have to do, that will free up time for your organization, both your own finance group or finance department, as well as some of the operational departments that are providing information for the closing process, and be able to reuse that time in a more productive way that will enable management to achieve some of the benefits that are attendant to an accelerated closing process. And so you always say, we don't have time to do this. Well, there's always time to do it a second time. I think if you streamline the process, you have better, more efficient processes that have higher data quality, you will find you've freed up time to do more productive things that really your staff will throw the pizza party for you and not you throw the pizza party for them. I think I've already made a compelling argument for improving the close process. But let me recap a few of the more important things. Certainly, better returns to shareholders. Another is the timely availability of management reporting and management information for faster and more insightful decision-making. Another is a better allocation and use of your resources, including the use of your staff skills and competencies. And last, to improve the data quality to ensure accurate reporting and a fast and effective process that leads to insight of information.
Someone is watching this program, and they recognize some common pain points. What's the first step they could or should take in improving the close process?
Mike, there are several steps, but the first step, clearly, is to define your goals, your expectations, and importantly, what's the ROI on the process? Another is to establish a sustainable working group and also to have effective sponsorship of your key executives and other functional managers. Another initial step is to prepare useful, realistic plans and assemble teammates that will help you with both internal processes as well as any external processes. Another, and I feel this is very important, is it's important to be structured and practical in what you're looking at. I think at that point, you design an implementation, a roadmap, and then follow that, but be adaptive. Things will change, and you need to be adaptive, but certainly at the same time, you want to make sure you do not deviate significantly and materially from your goals, the expectations you set, and the planned return on investment that you think this project will offer to your team.
Well, Larry, as usual, you've certainly covered a great deal of useful information for our viewers. If they could take one thought away from today's program, what would you like that to be?
Mike, I'm going to end the same way I began, with a cartoon. And the cartoon describes a salesman with a gun speaking to soldiers with swords trying to defend themselves from attackers. The soldier turns to the salesman and says, I don't have time for any salesmen. Don't you see I have a battle to fight? And so my one takeaway thought is, even though this might sound like an esoteric approach, you need to find time in the year to be able to pursue this because of all the clear benefits that we discuss today.
Decision View's Lawrence Maisel, thanks for bringing us up to date.
Mike, my pleasure to be here, and I hope this has been very valuable to your viewership.